Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome, everyone, to Fun with Annuities, the #1 annuity podcast on the planet. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. Yeah, that's me. Today, we have a great guest. I'm so excited she's joined the program. But before I just throw the ball to her and let her run with it, I've got to tell you a little bit about her. Her name is Dana Anspach, and she has a financial advice firm called Sensible Money. You can go to their site at www.sensiblemoney.com. She founded it in 2011, but she's been in the business a long time before that. And she does all kinds of things on the, if you go to the web, the site, she has webinars, she has, you can do a complimentary consultation, she has blogs. I mean, there's a lot there. There's a lot to download. Once again, sensiblemoney.com. And I'll have it on my site, as you know. Welcome to everyone listening to all the podcast platforms and also the people on the Fun with Annuities YouTube channel. And as you know, Stan the Annuity Man YouTube channel is a big monster as well with all kinds of videos on annuities. Now, as I said, Dana founded Sensible Money, and it is one of the nation's leading experts on retirement planning. She is herself and also her team. But she also focuses on what's called decumulation, and we're going to talk about that. She's been quoted by every financial publication on the planet, as you can well imagine. She's recognized by Investopedia as one of the top 100 financial advisors. I think they're wrong. She's top 10, and I don't know who the other 9 are. And this award is given to those who are making like huge contributions to financial education. She has one of the best books on retirement I've ever read. It's called Control Your Retirement Destiny. And once again, if you go to sensiblemoney.com, you can download the first chapter. She also has a podcast that you can find on Apple, Spotify, iTunes, etc. Control Your Retirement Destiny. This is the one I really like. And listen up, people. She has an online course called How to Plan the Perfect Retirement. It can be found at thegreatcourses.com. And I think that is fantastic. Now, let's talk a little bit about Dana's personal life. She rides a Harley Davidson. My research team tells me it's a Softail Slim. I have no idea what that means, but I'm sure it's cool. She was born in Iowa, but here's where Dana and I, the only thing that I disagree with Dana on is she's a Gator. She went to the University of Florida. I have no idea how that even happened. I'm sure it was a full scholarship for her brain. But hey, Dana Anspach, welcome to Fun with Annuities.
It is great to be here, Stan. You make me sound so amazing. Thank you.
You are amazing. You're fantastic. Let's jump right in, Dana Anspach, because the people are leaning in, waiting to hear this. Now, when I say the word juicing, I'm not talking about me drinking juice, which I do. Dana has come up with something called juicing your retirement money. And it's a strategy that she uses with clients. And on her site, there's 2 types of juicing methods. But I think this is fantastic. Dana, I'm going to throw the ball to you. Let's talk retirement juicing. Tell us what that is.
Yeah, absolutely. So many years ago, I was having breakfast at this place called Butterfield's. I'm here in Scottsdale, Arizona, and they serve fresh squeezed orange juice. And you watch the oranges roll down this metal contraption and into the machine, and out comes the most delicious juice.
Right.
And I had been making homemade margaritas at home the weekend before, and you're squeezing. I use fresh oranges in my margaritas and squeezing them, and there was always extra juice left over in the rinds. And, I watched those oranges roll through the machine, and I thought, oh my gosh, I wonder how much extra juice they get out of each orange because they have the right equipment. And this light bulb went on, and I was like, that is what we do for clients with the right planning process. And what I mean by that is not picking the right investments, not finding the right stock or evaluating market trends, but there is so much juice you can squeeze out of a retirement income plan by doing things in the right order, by planning on when and how you take Social Security, by coordinating that with your spouse rather than making independent decisions, by deciding whether you should add an annuity into your plan, by tax optimization, not just making your investment portfolio tax efficient, but really figuring out when you should draw out of which type of account, whether you should use Roth conversions. And so all of those things are equivalent in some cases to adding hundreds of thousands of dollars to your net worth. And so that is the process that we trademarked and refer to as juicing.
Love it. I mean, I'm glad you didn't call squeezing oil from a brick, because that wouldn't have worked. But I love the concept. And as you were explaining it, I'm thinking about when I grew up in North Carolina in the middle of nowhere, and there was this drugstore and they sold what was called orangeades, and they squeezed the juice. They had this machine and it got every single thing out. I'm like, I know exactly what you're talking about. But in essence, that's what retirees need to do, right? Because, you know, they get to chapter 2 of their life and there's not as much money coming in as because they're not working or whatever. You have to maximize, right?
You have to maximize, and a lot of research shows that many retirees actually have more wealth at the end of retirement than when they started retirement. And I think a lot of there's this fear of, oh my gosh, you know, people routinely tell me now, Dana, you know, I'm not going back to work. And it makes me chuckle. Yes, that's what we do. We only work with people transitioning into retirement. We are very clear on how solid your retirement income plan has to be in order for you to make that decision and truly exit the workforce. And so, yes, we get that you have to live off of this, your acorns. You have to live off of them the rest of your life. And it's super scary. And so I think when people don't have that planning process and it's not thoroughly tested, they had to hang on to all their acorns. And so for us, the process is not only about maximizing what you have, but also, I want to say, enjoying it at a reasonable pace. And what I mean by reasonable pace is, you know, nobody wants to go out and just spend money for the sake of spending. And a lot of retirees have wealth and savings because they were pretty thrifty to start with, which is great. But you also don't want to, you know, be so thrifty that you end up with all this wealth and you can't take it with you and all these experiences you didn't have. And so when you have this process that helps show you that, yes, you know, you could afford to gift to the children or help them out with a down payment or help them with tuition, or take the whole family to Disneyland. I've had clients do that. Or take the whole family on an Alaska cruise, or, you know, small little things. Have a house cleaner come in as your body aches and it's getting harder to do the things around the home.
Right.
Having someone help with the lawn care. Simple things that make your life a little easier, but you're afraid to do that if you're afraid of running out of money. And when you have this process that's quantifiable and measurable and has set metrics that we look at, it helps bring that peace of mind that, yes, I could afford to do that, and it would not jeopardize the 80-year-old me or the 90-year-old me. That person will still have enough and be okay. And that's what we love about our process, is that peace of mind it brings to allow people to, you know, not necessarily splurge on useless things, but just those small little extras that can make a difference in life.
Yeah, it's about lifestyle in chapter 2. I always tell people that, you know, there's 10,000 baby boomers hitting the age of 65 every single day. I mean, they want to know that they can live the lifestyle that they worked hard and scrimped and saved and sacrificed, but now they're there at the finish line and they need to achieve that. Let's talk about the process a little bit with Sensible Money. I want people to understand, you know, how you guys work, and you have a great team. I've been to her offices in Scottsdale. Fantastic team. They're all on the same wavelength as Dana. So, you know, Dana is a very calming effect. If you're looking for just kind of a mad, smart, chill advisor, I mean, that's her. She is that person that can guide you through retirement. And I've referred so many people to her because of that, because that's the personality that I think a lot of people need guiding them in retirement. So they go to sensiblemoney.com. And by the way, for everyone, Sensible Money is one word. Okay, so sensiblemoney.com. They go there and they sign up for the free consultation. I thought that was nice of you to provide that, considering who you are. So they do the consultation. Can you walk people through what that entails?
Yeah, so there's a form online. It's a secure web form. We intentionally don't ask for any personal information. For example, we ask for your age, not your date of birth.
Right.
So just to give us some general information, but it's a HTML secure form that comes to us. And
Mm-hmm.
then we set up that introductory meeting. It's typically not with me. I am primarily focused on managing the team. So it's with one of our planners who is both a certified financial planner and holds a secondary designation, that of a retirement management advisor. And if we get to talk about that in a little bit, that would be great. That designation holds a very special place in my heart and has really helped us build our entire
If
process.
you want to segue right there and talk about that, we'll come back. Let's talk about that specific designation and why that's important in combination with the CFP.
Absolutely. So the CFP we would think of as like a bachelor's degree, and the RMA designation, like getting your master's in retirement decumulation, meaning what are all of the risk factors that someone now at that point in time where they're spending their money, they need to live off of this nest egg for the rest of their life. What are all of those factors? And they are different things. And back in 2010, I was seeking additional information on this decumulation phase and came across this conference that was being held at the Morningstar offices in Chicago. And I fell upon the RMA designation, was in the very first class to acquire the designation in 2010. What I fell in love with was it was a room full of PhDs and MBAs and people, not salespeople. I had been to a lot of conferences that were about selling product, but these people were really trying to solve this problem of how do we make people's money last and how different it is in the accumulation phase and the type of analytical testing that has to happen to make sure a plan is going to work. And it just spoke to me. I was like, this is it. And my entire book was based on the principles that I learned in the RMA designation, because I came out of that going, you know what? The industry isn't doing it right. They're still so focused on accumulating assets, which is relatively easy compared to the math problem you have to solve when you start drawing money out.
True.
And so it was, an inspiration to me, all of our planners, in order to work with retirees that are getting ready or near retirement. They have to get the RMA designation. We actually pay for them to acquire it. So we think it's super valuable. It's a way of thinking about the problem. And that way of thinking is what we apply throughout our entire planning process.
So you're sitting down with the client, the initial consultation, they're giving you obviously confidential information, not detailed, but everything, you don't share it or sell it or anything like that, but they're going to give you that. And then from there, what happens?
Yeah, so part of what we do in that introductory meeting is explain our process. So when you hire us, it is a series of strategy meetings that we engage in. And at each strategy meeting, we run one of 3 different what we call retirement readiness tests. So the very first meeting is really around, does your plan work from a 30,000 foot view? You have this much assets now and this much future income coming in from Social Security, rental, annuities, deferred comp, stock options, whatever it may be. We're projecting all of that out in a timeline format, along with your projected retirement expenses, including healthcare and adding inflation and, maybe future home purchases, whatever it might be, and saying in big picture terms, does it work? Do you have enough to retire when you want to retire and maintain your lifestyle? And if it doesn't, how do we begin to tweak it? Would you need to work a little longer, spend a little less, downsize? What are the factors that would make it work? And we try to frame that in terms of choices. So some people will say, gosh, if I could downsize and reduce my expenses by 10 or 20,000 a year, are you telling me I could retire next year? Done deal, right? They are ready to be done. Other people would rather work till they're 70 or even mid 70s. I've encountered people who, enjoy it and they want to keep contributing. They don't want to retire, but they like the peace of mind knowing that they could. So people are very different. But that first meeting helps bring that into, what kind of factors are we working with here? In strategy 2, and I will say, most financial plans that we see, particularly any ones marked as free or from major firms, all they do is what we do in our strategy 1 meeting, is this big
Right.
picture, high level. Oh, you have this much, your probability of success is,
Right.
89%.
It's cookie cutter. Your process is not cookie cutter. Definitely.
Correct. We start with the cookie cutter because it gives us a very
Yeah.
general
It's the
view.
foundation.
It's the
Sure.
foundation. Then in strategy 2 is where we get into what I call the juicing part, where we start playing around with factors. How do we optimize Social Security? What is your tax rate now? Are there going to be years where we could realize taxes at a 0% or a lower capital gains rate than what your current rate is? Are there going to be years where Roth conversions are going to make sense? Should you be contributing to your Roth 401k or your traditional 401k?
Right.
Should you be contributing more to a deferred compensation plan or less? And so, and I've had just in the last 12 months, cases that came back with completely opposite answers on that question right there. One client where we said, you only have 2 years left. You're actually contributing too much to your deferred comp. We need you to ratchet it back.
Wow.
And another one based on their tax rates where we said, you could actually up yours a little bit. So we can't answer that question without all of the details where we are projecting your income and you're running your income through a 1040 tax calculator so that we can see exactly what your tax return may look like and make decisions that help improve the outcome. So strategy 2 is where we're digging into those things and often building custom schedules for people that have stock options or restricted stock units or annuities. Annuities have, as you know, all kinds of interesting features where the income can kick in later or kick in now. And traditional software doesn't allow you to account for these things very easily. So we have to build these custom schedules so that it can be treated accurately for taxes and accurately for cash flow. And so at strategy 2, we are running the second, what we call retirement readiness test, which is a test that works much like a pension plan. So if any of your listeners have pension plans, they will send you an annual fundedness letter.
Right.
Your plan's 80% funded or 92 or 71. And so what that fundedness calculation does for a pension plan is it looks at all of the future cash flows that the pension plan has to deliver, the paychecks, and it translates those cash flows into a present value. What dollar amount does the pension plan need to have in assets today to meet those future obligations? Well, we do the same thing at a household level for a retiree.
Nice.
We project all their cash flows that they're going to need from their portfolio. We take the present value, and just like a pension plan, we calculate your household fundedness level. So that is you hear about the 4% rule where you can withdraw 4% of your assets per year. But in reality, spending doesn't work that way. Some years we need to buy a car or we have a family situation or a vacation. And so we don't spend the same amount. And what the fundedness test does is it helps us project a lot of these lumpy cash flow items and say it's like a lifetime 4% rule. Over your lifetime, does the amount of spending that we have projected for you make sense based on your assets? So we love it. It allows us to very easily test lumpy items. People say, can I buy this second house? Could I afford this car that I want? And we can very quickly give an answer, even though it might mean a larger withdrawal in that single year. And then we move on to strategy 3, which is when we start to dig into the construction of the portfolio. And so we don't get to that till last. We want to optimize someone's plan based on all of these other non-investment levers. And then the last thing we look at is, now that we understand the job each account has to do. And let me take a simple example of a husband and wife that might have a 10-year age difference. And their retirement accounts are often invested with the same asset allocation, 60% stocks, 40% bonds. But we go, well, the husband is going to have to start withdrawing or taking his required minimum distributions at his age, now 72, and the wife won't have to start hers till 10 years later. So the cash flows those accounts have to deliver have a very different time frame. And so when we get down to that account by account level, it leads to allocating each account so that it matches up to the cash flow needs it needs to deliver. And so you might not have each account allocated 60-40 or 70-30 or whatever it may be. Each one is specifically aligned to the particular job that it has to do. And that can help reduce certain types of risks that you face when you're drawing out. It can also allow other accounts like Roth IRAs to be 100% invested in growth, where they have the opportunity to earn, or the possibility of earning, higher returns and growing in a tax-free environment. So there's all kinds of good things that can happen over long time frames when you pay attention to all these details and make sure that everything lines up.
I know that there's so much more to it than that, but I want to stop here, and I want to ask everyone listening and viewing this, I want you to think about your current advisor, if you have one or not, but let's just say you have one. Are they even in the ballpark of being that detailed? For goodness sake, one of the things you said was you don't want your retirement to be lumpy. The only thing you want lumpy, Dana, is your oatmeal or your mashed potatoes, preferably mashed potatoes. But you don't want your retirement to be lumpy. And what I want to tell people is this process is worth it. I mean, it's like, it's a financial physical. I know that's cliche, but you have to take this stuff serious. And one of the reasons I wanted Dana on is for her to explain the process so that you can go, wait a minute, that sounds legit, because it is. And why is it my person doing that? Which is a good question, which then leads you to go to sensiblemoney.com and at least interview them to see if it's a good fit. One of the things you mentioned in there, Dana, I want to pivot because I was on your site and you had a really good download that I loved. And it was called 4 Things Retirees Need to Know About the 4% Rule. And you just mentioned the 4% rule, but I'm glad you mentioned it because it segued into this. Let's cover those 4 things. And again, you can go to her site and download it. Hello. 4 things retirees need to know about the 4% rule. What are those 4?
So I don't know if I'll get them in order. We'll see. And you'll cue me if I miss one.
That's right. That's right.
Yeah, that's right.
I've got you.
So inflation. When you look at the 4% rule, it generally, if you had $1 million, it would say you could withdraw $40,000 a year and increase that with inflation, over a 30-year time frame, and have a very high probability that you would never run out of money. And that's great. And yet, when you look at how inflation actually impacts retirees, it often doesn't impact them as much as you might think. And so take today's environment as an example. Most of our retirees already own a home. Many of them have a mortgage that's paid off. If they didn't, they often refinanced and just got lower rates and locked in that cost. And so inflating housing prices right now are not having any negative impact on them unless they want to downsize. But based on their current, their wealth is growing on paper, but the house is not a consumable, right? They need to live somewhere. Contrast that with someone that's 30 years old and trying to buy their first home. Inflating home prices right now are having a big impact on them. So inflation in that asset is impacting these different demographic segments quite differently. And so we see that in many cases throughout retirement. And there's a lot of research that has shown that, yes, retirees need their cash flow to increase each year to keep up with rising prices, but they don't need it to increase at the same pace as inflation. And so we're able to build in customized inflation assumptions based on the demographic of the household. Higher net worth households, inflation has a lower negative impact on them. That makes sense. If I'm retiring on $40,000 or $50,000 a year and the price of energy, gas, milk, groceries, healthcare goes up, that's a big bite of my budget. Yeah. If I'm retiring on $150,000 or $200,000 a year, I easily absorb those price increases and it doesn't have as big of a negative impact on me. So that's one of the areas that the 4% rule, treats all people equally, when in reality, inflation does not impact all people equally.
Your housing example was fantastic. It does affect different demographics differently. Hate to say differently, but that's a really good point. So inflation, what's the second?
The second would be taxes. And so again, if I have all my money in an IRA and the 4% rule says, I can take $40,000 a year out and I don't factor in income taxes, well, if my tax rate's 32% or even 28%, I don't actually get to spend $40,000 a year, right? I'm lucky if I get $30,000 a year after taxes, and then you have to factor in state taxes, not just federal taxes. But if I have my entire $1 million in a non-IRA portfolio, and much of that is structured to take advantage of capital gains rates and qualified dividend rates, which can be incredibly low, I might pay almost nothing in taxes on that $40,000 that I want to withdraw. So the 4% rule doesn't help people distinguish between after-tax income or gross income. And so if you have all your money in your qualified IRA, 401k, 403b type accounts, it can be very misleading. You're going along thinking, great, I'll have $40,000 a year to draw out of this account. Not so fast. A big chunk of that's going to Uncle Sam. So again, when you get near retirement, you need very customized projections that do take that into account, so you can actually estimate what you have available to spend, not just your gross. Yeah.
Number three.
So let's see if I can remember what I put in as number three.
Or number four. Just go either way.
Or number four. Yeah. I believe one of them was simply spending. So we don't spend in nice, even amounts. And so this is what I alluded to with my earlier comment about using a household 4%, what we call a fundedness rate, is we buy cars, we, go
or Harley Davidson motorcycles.
Yes, or Softail Slims, which I was very
Softail Slim, Harley Davidson. Yeah, how about that?
Very impressed with your research team. They deserve, a bonus for that one.
So some people buy Harley Davidsons on a whim. So spending, yeah. So keep going. I'm sorry.
Yeah. So you don't spend in a nice, even amount. And when you have other income sources, I know this is one of the things in that report also, like Social Security coming in. Well, let's say I want to retire at 62, and if I've done my homework and I have a healthy, relatively healthy life, I probably shouldn't start Social Security till age 70. Well, I have this gap where it might be perfectly okay for me to withdraw a lot more than 4% from my portfolio for that 8-year window, because then once Social Security kicks in, I might only need to withdraw 2% a year from my portfolio to supplement my Social Security. But I don't want to wait until Social Security kicks in at 70 to have a certain lifestyle. So I want to draw enough out in those intermediary years. Well, usually when you do the planning right, that can be perfectly sustainable.
Right.
But if I was only using the 4% rule, I would say, oh no, I either need to start my Social Security early or I'll have to work longer. It wouldn't be easily apparent that your portfolio could sustain those extra withdrawals. So I may have just combined item 3 and item 4 into one in terms of lumpy spending, which is the reality. We don't spend a nice even amount each year, and the 4% rule does not help us account for other sources of income, Social Security, annuity income, rental income, and pension income. The fact that spouses have income sources that start at different ages. And so all of these things create a varied pattern of cash flow during retirement. And what you need is withdrawals to supplement those other sources. And that rarely works out to a nice, neat 4% number.
Once again, sensiblemoney.com, you can download the full book and the details. She's just glossing over and just trying to, someone with her IQ, she has to talk down to us people just to make it simple. She is mad smart and one of my favorite advisors in the country.
I have to add something.
What's that?
So I was talking about, I know this is in the report that's available as a download, but the other item the 4% rule doesn't account for is what I call, it's not my term, I didn't make it up, but it's referred to as GoGo spending. So in retirees, there's this pattern of we retire, we have our GoGo years, and people tend to spend more. And then you enter your slow go years where spending actually decreases in inflation adjusted terms. And then you often reach what we call the no-go years, where you're spending more on healthcare and help around the home. Well, during those GoGo years, when we project spending in retirement, we project it in this linear way. But if you account for this pattern, you can actually show people that during your go-go years, you might be able to afford to travel more and do some of those extras while you're still mobile and healthy. And then we're going to taper off that spending during your slow go years. And then it might creep back up in later years with healthcare. But you're allowed, you want to customize that. And that is the other thing the 4% rule simply
So it could be go, go, no go, and can't go.
It could be. We don't
can't
know.
No, exactly. Interesting. I mean, I really like your unique take on things. I mean, you obviously in the financial planning world and the world that you're in, there's been a lot of ideas. I think you've taken the really good ideas and you've Danified them, for lack of a better phrase. But I think that you've done it in a way that clients can fully, understand the process, which I always say to people, if you can't explain it to a 9-year-old, don't buy it. No offense to 9-year-olds. Your system is complex yet understandable, which is the reason that I really like it and gravitate toward it. I want to pivot a little bit and cover some things that, when we kind of announced to our clients, and there's a lot of non-clients out there as well, that we were going to talk with you. They wanted to get your take on a lot of things. One of them was, and obviously I'm not going to hold you to the answer because nobody knows the perfect answer, but give us your overall outlook. And at the time of this taping, so everyone listening and viewing, look at the date. So if you're listening 3 years from now, it's dated. Just markets in general, interest rates, just your overall. You've done this a long, long time. What's your overall feel about where we're at right now at the time of this taping?
I started in 95 as a financial planner, or what we were called a registered rep at the time. And so I went through the .com, bull run.
Sure.
And I will tell you, in the late 90s, I remember people who wanted to put 100% of their money in science and technology mutual funds. And I remember asking one person to sign a disclosure form because I wasn't comfortable with that.
Right.
And eventually it all crashed. And, here you were at the time trying to give advice on diversification and not chasing these trends. And it was very difficult to get people to do something that would be in their long-term best interest. And then we went through, that was essentially almost a 3-year downturn of 99, 2000, 2001. And then, of course, we had the run up to 2005, where we had this crazy bull real estate market, and then the ensuing crash. I had clients that retired in December of 2007. Mm-hmm. They are fine. It was super scary. But we had stress tested the plans and nobody had to go back to work. And, it works. Planning works. And so then I've been through, the ensuing decade since then, where it seems that every year, people are waiting for that next crash.
Sure.
And we, of course, got that during the pandemic from as usual, some unforeseen outside event. And now here we are at what people have often referred to as an incredibly overvalued stock market. And the truth is, nobody knows. I mean,
exactly.
There are so many headwinds, good, I suppose I should call them almost tailwinds that we could look at. Of course, there's headwinds too, but there's a lot of incredible things happening with technology that can improve productivity right now. And can the stock market continue on the sustained double-digit returns? No, it never can. So my answer when people ask me about the market, I had a client ask me a few weeks ago, so, when's is there going to be a bear market? And I said, yes. I always answer yes.
Absolutely. I just don't know when.
Just don't know when. And so what you got to do is prepare your portfolio for that. Right. You have to have some type of rules-based system to take gains off the table. We are doing that aggressively right now.
Okay.
So these gains, incredible gains we've seen in the last year, you take some of those gains and you park them into a safer, low volatility. It's not going to earn much. The price of safety is a low return, so you have to accept that. But you're parking some of that in a safe place so that you can use it to draw out of when you need to. In terms of interest rates, again, since the Great Recession, we have been saying that there will be higher interest rates in the future, and we had just started to see 2% yields on money market funds
Right.
in January of 2020.
Right.
Before this hit, I remember so excited, like I can earn 2% on a money market fund again. Oh my gosh. It's been since 2006 since we had seen that.
Right.
And now here we are back to zero. It won't stay that way. And so
Right.
my answer to all these market questions is don't get caught up in these minutia.
Mm-hmm.
The media focuses on the minutia as if it was a sports game and they're calling out the play-by-play. After 25 years of doing this, none of that is really going to impact your retirement security. You are going to harm yourself more by trying to guess what's going to happen next and guessing wrong than what you can accomplish by simply following a disciplined plan that's designed for a 20 or 30-year time frame.
As I always tell people, these are old cliches. The bell doesn't ring at the top or the bottom, right? Bulls make money, pigs get slaughtered, as they always say. But it's hard for people to, in the go-go times. I'm assuming you're getting calls on crypto, Dana Anspach. So let's get the Dana Anspach take on crypto, and you're not allowed to use the words tulip bulbs. So go.
Well, I actually am a big fan of crypto, and
Good, neat.
Yeah, so I started a deep dive on crypto well over a year ago now. I heard Tyrone Ross is his name. He founded a company called OnRamp, which is helping financial advisors deliver digital asset portfolios to their clients. Well, I heard him speak at an industry event that really, piqued my interest for me to go, okay, there is something there. I have to learn more about it. This just isn't Bitcoin and the latest fad, which is how I thought about it before.
It's not. You're correct.
Yeah. And so I started consuming books, podcasts, every website article I could find. I started investing. I opened about 5 different crypto accounts and learned how to move money from wallets and do all of this weird stuff. Now, there's certainly ways to invest in what we refer to as digital assets without doing all this weird stuff. But I really wanted to learn how it worked. And so, I would transfer, $50, something small that if I did it wrong or lost it, it wasn't going to hurt me. So I could figure out and learn what this crazy quote crypto world was. My conclusion is it is a new investable asset class. And so digital assets, I think in as soon as 10 years, possibly sooner, we will see the digital world essentially replace a lot of the typical banking functions and stock trading functions that really happen very manually right now. So think about music and your old 8 tracks and then your cassette tapes and then your CDs. And now who even has CDs?
Exactly.
It went digital. Well, money is still incredibly manual. Even the process of a credit card transaction is so antiquated compared to music or movies or so many other things that are digital now. And so money is going digital. What that's going to look like in its final form, I don't know. Will we see additional regulation? Yes. We've seen enough regulation earlier this year and actually late last year that institutions started getting more comfortable adding Bitcoin to their balance sheet. Banks are allowed to custody digital assets now. So the people who are saying it's going to get regulated out, it's not going away.
No,
will it evolve? Absolutely.
Yeah.
There's over 5,000 cryptocurrencies out there right now. Just like the .com era, many of those didn't make it.
Yeah. Most won't. You said something that I wrote down that I've never heard it put this way, but I think it's the best thing I've heard on crypto is that money should not be manual. And right now it's manual, and that's a really good way to put it. And eventually it will not be manual because the market will demand it to not be manual and not be hard. And so I think the blockchain, I've said this on numerous podcasts, the blockchain technology is legit. Crypto is riding on top of that. We just don't know which crypto version is going to be the winner at the end, right?
Yes,
okay.
Exactly. And, Rick Edelman started a new certification in digital assets that I actually went through his program and finished it.
Of course Rick did. Why wouldn't Rick do that? He's doing everything else, for God's sakes.
And so, the take on it throughout that course was, for most people, an allocation of 1% is sufficient. It's new, it's speculative, it's emerging. And so, we have a framework here. If our clients are interested in crypto, or if they fit that type of risk profile, we will invest them in a publicly traded version. It's one of the trusts, so it's ETH. The ticker symbol is ETHE, and small allocations, 1% at max 3% if it's a more risk tolerant client, in their Roth IRAs, ideally, where we put things that we think have the potential.
And what is ETHE? Edward, Tom, Harry, Edward, right?
Yes, it is essentially a publicly traded trust. It trades like a stock. All it owns is Ethereum, and Ethereum is a cryptocurrency, a digital asset that a lot of smart contracts and a whole world of finance called decentralized finance is being built on top of Ethereum. It's essentially a programming language. And, buying the cryptocurrency is allowing you to own a little piece of the technology, and it earns fees when people use it. And there's a whole lot more I could go on.
Well, they got to go to sensiblemoney.com and find out. To me, it feels, I'm dating myself. Dana looks like she just got out of college at University of Florida and she's going go Gator, but I don't. I just remember how this all played out in the .com era. But it reminds me, Dana, of when I was at Dean Witter, Morgan Stanley, UBS, Payne Weber, of managed futures. You put a small percentage of your portfolio, less than 5, obviously. You're saying 1, which is great. But that's the way I look at it. Are you actively, with clients that understand it, are you actively putting that in their portfolios or advising that?
For a few clients, and again, 1% allocations, yes, we are. And, we think we replace, so in our portfolio models, we use small cap or small cap value as a part of their asset class. And so we will say this, digital asset is replacing 1% part of the allocation that we would normally have in small cap value, which is an aggressive asset class anyway. And so we want to look at it as a 5 to 7 year hold time. Yes, it's highly volatile. So expect that it can be down 50% in a week. That's just the way it works. And it's not appropriate for everybody. But for people that have higher risk tolerances in very small allocations, we think it has a lot of potential when I'm looking out 5-10 years, not something I'm going to trade.
Agreed. And I think, as we've seen before in the housing bubble and all the stuff, the .com era, people that shouldn't be going all in are going all in, and they're leveraging going all in. So, I mean, it will work itself out. It'll bottom itself out, and it will clean out the speculators, and then it will be, I think, legitimate going forward. I had a question, but once again, Dana Anspach saying money should not be manual is the takeaway from that crypto discussion, which I think defines the reason that it's going to be here. Money is hard. Pennies and nickels and dimes are hard. Credit cards are actually hard. She is right about that. But I wanted to pivot to something. There's a lot of wealth transfer going on. I always say inheritance is the best business you could ever be in. It's foolproof. You just have to be there. Okay. When you are talking to clients, there's either clients that are saying, hey, I want to give money away or make sure that my family's going to live well, but I don't want them to show up, in a helicopter to my funeral and then helicopter off to the boat they just bought. And then there's the other side, which I kind of want to pick your brain on, people that are going to inherit money. Is that part of the overall plan for both sides of that wealth transfer?
Yeah, it's not too often that we have people that want to include an inheritance in their projection model. Sometimes they do, but most people are, they might just not feel right about that.
But it happens when it happens. I think, though, that more and more people need to do that.
Yeah, and there's other people who will factor it in in the back of their mind. And so they might say, I don't want to include this in my plan, but does my plan work? I just had someone who, does my plan work if I buy this condo in Florida? This is a client that lives in Texas.
Sure.
Yes. And, he's right on that cusp of where we want to see his metrics come in,
right.
the retirement readiness test.
Right.
But in his mind, he also knows it's just he and his brother, and they're going to inherit a substantial sum, and his mom's 90. And so he's like, okay, if he didn't have that, he probably wouldn't feel comfortable moving forward with the plan in Florida. So basically we can stress test it and say, well, if that didn't materialize, at some point you'd probably have to sell either the Texas home or the Florida home, one or the other. You're not going to be destitute. But because he knows he has an inheritance coming, it just made them that much more comfortable moving forward with something. And where we often get involved is when the inheritance actually happens, and now people are wading through, what are the tax consequences? Should I sell these assets? How do I invest these assets? Wow, I didn't know I was getting this much. Now what can I do? Can I upgrade my home or, do some of these other things? And so that's always, a fun situation to be in, to be able to show people that the difference that it's going to make in their current lifestyle.
Would that be under Grim Reaper juicing? Like you show a rotten orange, you're like, we have to factor in the rotten orange, because I love the whole juicing thing. Right now, I mean, what are the biggest, when you talk to retirees, either pre-retirees, people that are retired, or people that are coming to you that have been retired for a while and they're switching to your platform and your advice? What's the biggest worry that people, is it healthcare? Is it long-term care? Is it interest rates? Is it outliving their money? What is it? What are people really stressed about right now?
Yeah. So I wish I could, quantify that into one thing, but it's all kinds of things. I mean, the biggest reason people seek us is, can I retire? And I want to know I won't run out of money. Very simple, big picture. And then they know it's all we do is this type of retirement income planning. And so their current advisor usually doesn't do this type of income planning. I was just talking to one of my colleagues in the hallway right before I joined you on this podcast, and he was saying, this gentleman that just hired him, just sold his business or is in the middle of doing the final paperwork and has an insurance agent and has a stockbroker, but they're all like, telling him this, telling him that, but no one can actually lay out the roadmap for them of how much money can they have and what can they afford. And so we find that's really what they want to know, how much can I have? And am I taking advantage of everything I should be taking advantage of? The whole, what we call juicing process, right? Am I doing it right? Am I taking Social Security at the optimal time? Should I be taking my pension at this age or that age? Should I be buying an annuity? Does that make sense for me based on my longevity? Should I be spending this much, or is that going to be too much? Should I be taking money out of my IRA, or should I be taking it out of this trust account or brokerage account over here? And what should I sell? Think about every year when you're taking money out, you're having to sell something to raise cash to withdraw. And even that decision can stress people out. What should I sell? Should I sell this or this in this account or that account? And so they can be coming to us for all of those reasons, but it's usually, in a really big picture term, peace of mind and wanting to know that the latest election or the latest interest rates or the latest infrastructure bill or whatever it may be is not going to derail their retirement plan.
And once again, people need to hang on to the word decumulation, and don't let that scare you. Again, decumulation, not accumulation. Decumulation is where we're all going to be in chapter 2 of our lives. And you need someone like Dana to guide you through those waters. It's choppy. It's always going to be choppy. It's always going to be volatile. But if the plan's in place and you stick to the plan and you don't react emotionally, you're going to get through it. How do you handle that? When let's just say markets go down, are your clients ready for that? Do people panic? And if they do panic, do you just refer them back to the plan? And I'm assuming that helps, correct?
You would think so. So, I'll tell you a funny story, and I'm going to go back to Bitcoin and crypto for a second.
Sure.
So,
Yeah.
I told you I started my deep dive last year, and so I bought $1,000 worth of Bitcoin and Ethereum, and it went down, and then it went back up, and it was up $100 over where I bought it, and I was like, "Oh my God, it's up!" I sold. And so, and now in my mind, when I bought it, I said, this is a 10-year hold time. $1,000. $1,000 is not going to make or break my
Sure.
plan. And so my own self, something outside of the normal way of investing, emotional reaction watching that made me just laugh. I thought, oh my goodness, you need a financial advisor. You told yourself. Right?
Dana Anspach walks down the hall and hires one of her people to manage her money, right?
Yeah, I said, you told yourself a 10-year hold time and you managed to last 2 weeks or something.
It happens
like
to the best of them, Dana.
So
That is hilarious.
it was great. And so, it just reminded me of the value of what we do when things happen like last March and the markets are down substantially. We remind clients that we don't have to sell anything right now. The money you're using to live off of is already in a safe, stable investment. We designed it that way. We call it a runway into retirement. Matter of fact, you could live off of the safe, stable part of your portfolio for the next 5, 7, in some cases, 10 years before we would have to sell a single one of your stock investments.
Wow.
And the clients that get that, it does bring them peace of mind. Sometimes we have to remind them. We would have on the same day one client emailing us, thanking us because they really understood the portfolio structure and saying, thank you. I just feel so much more relaxed than I did during the last market downturn because I get it. At the same day, I would have other clients panicked.
Sure.
Because they were just looking at the top line number on paper and that, their portfolio was down some enormous amount. And I remember this one client, $5 million client, big number. And he's like, I just don't see how it could ever get back to its target rate of return. Not 6 months later, we were back on target. And he just, they can't see it in the time because your emotions can get so tied up in that number on paper. And that's where we can really add a lot of value is helping people step back and not make any rash decisions at that point. If that client had made a rash decision, he would have $1 million less today than what he has. And, that value of that calm, somebody to explain and keep you on track, when your emotions get in the way, which is just normal. We're normal humans. Look at me with my Bitcoin.
That's right. That's right. Tell people a little bit about your book, which I think is fantastic. It's called Control Your Retirement Destiny. And it's a good read. What motivated you to write that other than to just get it out of your head? What's the goal of that for the reader to absorb?
Yeah. So what motivated me to write it was, as I mentioned earlier, the RMA, the Retirement Management Advisor designation, that curriculum and this way of looking at how you really plan for retirement, where you need to spend money regularly, right? You saved your whole life so that you could live off that savings and maintain your lifestyle. And there's so many tweaks that can improve the outcome for people. And I wanted to lay it all out. So I wanted people to have a path that there's a lot of people who do their own retirement planning, but it would give them all of the things that they needed to do, as well as an introduction to people who don't want to do it themselves, but they're looking for that level of thoroughness to say, wow, okay, this is how you do it right. And then they can come find us if they don't want to do it themselves. What has been so rewarding for me is all of the reviews on the book.
Sure.
I think when you start off as an author, you have this idea that you're going to write some book and it's going to make the New York Times bestseller list and you certainly don't make any money from really selling books unless you get to some exceptional level. But I saw all the reviews and people that I will never meet, and some of them actually take the time to email or post, find me on Twitter and comment that how much that it helped them, how much it helped them lay out their own retirement plan. And I love that. And so
that's why we do what we do, right?
It
is. And by the way, you can go to our site at sensiblemoney.com and download the first chapter. I mean, you can get the flavor of the writing. Before we close out, because I got a couple more things, tell people about the online courses, which is it's www.thegreatcourses, one word, thegreatcourses.com, but it's how to plan the perfect retirement. When people go do that, how long is it? What do they expect? What can they expect from that?
Yeah, so the Great Courses has been around since the 70s. For those of you who've been flying that long, you used to see their ads in the Sky Mall magazines. And so they reached out to me a few years ago. It took a long time to record. It's a series of lectures, 12 lectures. Each one is about 30 minutes long. It goes through different phases. So I talk about, phases for younger people who are planning for retirement. And then about 3 or 4 lectures really focused on those go-go years. What happens in early retirement? How do you plan the transition right up to retirement and those first 5 to 10 years of retirement? And then I talk a little bit more about the slow-go years and the no-go years in terms of what might you expect in planning for long-term care and getting your estate planning in order. So the course is a life cycle course designed to cover from the time you're 20 and out of school or just starting out or starting over all the way through later retirement. What are the different things that you need to think about?
Interesting. Let's talk Harley Davidsons, Dana Anspach.
All right.
How did that happen?
I started riding dirt bikes at the age of 35. That was 2006.
You just woke up one day and you say, you know what? I think I'm going to ride a dirt bike.
A friend of mine started and, she's like, you got to try this. Go take my bike out one day. And I got hooked.
Love it.
I got my street license in 2010. And then I tried a bunch of different bikes, and one day I test rode a Softail Slim, and I was like, this is the bike for me, the weighting, I felt so comfortable on it. And so, I love it.
Dana Anspach is the founder of Sensible Money at sensiblemoney.com, an absolute superstar. If your dream is to have a very smart person that rides a Harley manage your money, I mean, she's the one, but it's bigger than that. She's an educator. But she's also an advisor and a very good one. And she's built an organization that I would encourage my listeners and viewers to view. Before we close it out here, Miss Dana, any last words for people? Words of wisdom? You're a juicer. We found out you're a juicer, a retirement juicer. Any words of wisdom for people before we close this thing out?
If any words of wisdom, it's a saying that I've lived by my whole life, which is, you got to focus on the things you can control, and you have to have a plan to manage all of the things that you can't control, and you got to let the rest go. And so don't spend all your time focusing on all of those things outside your control. Instead, get a plan in place, follow it, and go out and enjoy life.
That home run you just heard hit is from Dana Anspach, founder of Sensible Money. Dana, thank you so much for joining me on Fun with Annuities. We're going to have you back on and get more detailed with some examples next time. Is that okay?
That sounds great.
Sounds good. We'll see you next week on Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.